Good morning. Here is today's Korean economic news briefing. We begin with a significant development in labor relations. The government has announced that the revised Labor Union Act, often referred to as the Yellow Envelope Law, will officially take effect on March 10. In anticipation of its implementation, Vice Prime Minister and Minister of Economy and Finance, Koo Yoon-chol, presided over a meeting of relevant ministers yesterday, emphasizing efforts to ensure a smooth transition and stable application of the new legislation in workplaces. The government plans to operate the initial 3 months as an intensive monitoring period, closely observing on-site situations and responding proactively to any challenges. This new law aims to expand the scope of employers and restrict claims for damages against unions, a move designed to institutionalize win-win negotiations in principal subcontractor relationships. Minister of Employment and Labor, Kim Young-hoon, highlighted the importance of a cooperative spirit, describing labor and management as being in the same boat, navigating the rough seas of the Korean economy together. This legislative change is expected to reshape collective bargaining dynamics, potentially impacting corporate liabilities and labor costs, and will be a key area of focus for businesses and policymakers alike. Shifting our attention to the broader macroeconomic landscape, concerns are mounting over the persistent high exchange rate and rising inflation, which could jeopardize the nation's economic growth targets. Vice Prime Minister Koo Yoon-chol addressed these anxieties yesterday, stating that the government is monitoring the $1 exchange rate with a sense of urgency, especially as it briefly surpassed the 1,500 won mark during overnight trading. He attributed the current situation largely to external variables, primarily the escalating geopolitical tensions in the Middle East, particularly the ongoing conflict between the US, Israel, and Iran. While assuring that Korea's foreign exchange reserves, including private holdings, are robust at over $1 trillion, suggesting no immediate dollar shortage, the Vice Prime Minister acknowledged the severity of the situation. These external shocks are having a direct impact on domestic prices. According to the Bank of Korea, import prices in January continued their upward trend for the 7th consecutive month, rising by 0.4% from December. Economists are warning that this sustained high exchange rate, coupled with surging oil prices due to the Middle East crisis, could push Korea's consumer price inflation up by an additional 0.6 percentage points this year. Furthermore, the overall gross domestic product growth rate for this year could fall by 0.45 percentage points, with a further 0.24 percentage point decline projected for next year, casting a shadow over the government's 2% growth target. The current account surplus as a percentage of GDP could also shrink by over 2 percentage points, signaling potential vulnerabilities in the external sector. The financial markets have reacted sharply to these macroeconomic headwinds and geopolitical uncertainties. Yesterday, both the KOSPI and KOSDAQ experienced historic single-day plunges, recording drops of 12.06% and 14% respectively, marking what many are calling the worst day ever for the Korean stock market. This dramatic decline was primarily fueled by fears of a prolonged military conflict in the Middle East. The bond market also reflected this instability, with the yield on 3-year government bonds rising to 3.223%, a significant jump from pre-crisis levels. This widespread market panic highlights the extreme sensitivity of global financial systems to geopolitical developments and commodity price fluctuations. In light of these developments, the Bank of Korea faces a complex dilemma regarding its monetary policy. With inflation showing signs of intensifying and the growth outlook becoming increasingly uncertain, Bank of Korea Governor Ri Chong-yong's upcoming Monetary Policy Committee meeting, his last before potential reappointment, will be under intense scrutiny. While the upward pressure on prices suggests a need for tighter policy, concerns over economic growth and household debt burdens may lean the committee towards maintaining the current interest rate rather than an increase. Meanwhile, the U.S. Federal Reserve's latest Beige Book report noted an increase in regions reporting stagnant or declining economic activity, alongside persistent price pressures. This suggests the Fed might also maintain its hawkish stance for longer, potentially delaying the anticipated interest rate cuts and contributing to global financial market volatility. Turning to the domestic real estate market, recent policy discussions and market trends indicate a continued period of adjustment. The government is reportedly considering restricting Jaeon's long-term deposit lease loans for non-resident single homeowners in the Seoul metropolitan area. This initiative, driven by a directive from President Lee Jae-myung to strengthen regulations on non-resident single home ownership, could accelerate the trend of wholesale-ification, where apartment lease contracts increasingly shift from Jaeon's to monthly rent. Data shows that the proportion of monthly rent contracts in Seoul apartments has steadily increased, exceeding 50% since 2022 and reaching 55% last year, driven by tighter lending regulations and rising Jaeon's prices. Furthermore, the average actual transaction price of apartments in Gangnam, Seoul, dropped by nearly 500 million won in a single month, following the president's sustained pressure on multi-homeowners. With the deadline for the multi-homeowner capital gains tax deferment ending on May 9, many properties are being sold at reduced prices. These developments suggest that Seoul home prices, especially in affluent areas, are likely to continue their downward stabilization trend in the near term. In the industrial sector, the semiconductor industry is grappling with challenges in automation. Despite the broader push for automation and robotics in manufacturing, the semiconductor fabrication process faces difficulties due to a lack of standardization in equipment design and data structures. Industry experts highlight that achieving full automation in semiconductor manufacturing could take up to 8 years, emphasizing the urgent need for preventive maintenance, automation standardization, as a key competitive factor. On a broader scale, while investment in transportation equipment like electric vehicles and machinery for semiconductor manufacturing is expanding, the construction sector is experiencing a significant downturn, with a 11.3% decrease in completed construction work, the largest decline in 14 years. Adding to industry concerns, the Middle East crisis is causing significant disruptions to global supply chains, affecting not only crude oil but also the transportation of semiconductors, batteries, and pharmaceuticals that pass through the region, leading to potential delays and increased shipping costs. On the international trade front, the U.S. is reportedly set to increase its global tariffs from 10% to 15% this week. This move by the Trump administration, based on the Trade Act of 1922, aims to address the severe U.S. trade deficit. However, New York Fed President John Williams has cautioned that approximately 90% of these tariff costs are borne by American consumers and businesses, potentially hindering the Federal Reserve's long-term 2% inflation target. Finally, in the realm of artificial intelligence, a recent report suggests that the initial phase of AI adoption could boost corporate profits, but eventually lead to significant changes, including a potential rise in white-collar unemployment and a substantial correction in the stock market. Meanwhile, Jensen Huang, CEO of NVIDIA, has stated that the recent $30 billion investment in OpenAI might be his company's last, casting doubt on earlier speculation of a $100 billion investment. This suggests a more cautious approach to large-scale AI investments amidst the current economic climate. For our investors and general viewers*, the immediate future appears challenging. The surging exchange rate, high inflation, and global geopolitical instability, particularly in the Middle East, are creating significant economic headwinds. Investors should brace for continued market volatility and consider defensive strategies. Export-oriented industries might face difficulties due to rising import costs and global trade tensions, while domestic consumption could be dampened by inflationary pressures. For general households, the persistent rise in prices will impact purchasing power, requiring careful budget management. The government's focused monitoring of the new labor law and the real estate market will be crucial areas to watch, as these policies could have long-term structural impacts on the economy. Maintaining vigilance and adapting to the evolving economic landscape will be key for navigating these uncertain times. That concludes our economic news briefing for today. Thank you for listening.